Hello everybody, and thanks for tuning in. I'm Victor Haghani, founder and CIO of Elm Wealth, and this is the Elm Roundup.
So we recently published a piece looking at the probability of a stock market crash over the next year. Obviously, this is something that's really in the news. There's been books written about, recent books written about the Great Depression. Feels like every time you pick up the financial press, there's someone talking about the likelihood of a crash, an AI bubble, you name it. Can you talk a little bit about what went into this piece and how we thought about all the different ways to think about the probability of a crash in the future?
Yeah, absolutely. So it was a really fun piece. It's so much in the news, so many people talking about an impending crash. And so what we did was we looked at surveys. We went through a whole bunch of different ways that people might think about what this probability is. But our favorite is trying to infer the probability of a crash from highly traded stock market options. And so in the piece, we go through all the different ways that you could think about it, and then we spend quite a bit of time on how to infer it from market prices for options. And one of the things that we think would be really fun is if enough people read our piece, that maybe this probability of crash, as we've defined it, might even start to turn up on Kalshi or Polymarket. That would be fun to see how that ties out to what we're thinking.
So if someone is thinking a lot about what the likelihood of a crash is, or conversely, what's the likelihood of the market going up 30% over the next year, how should they think about these perspectives when they're making asset allocation decisions?
Yeah. So, asset allocation decisions should always be based on expected return, risk, and your risk aversion. We say that a lot around here. And, that when you're thinking about risk, the risk is not best thought of as the probability of losing money or the probability of losing a certain amount of money. That risk is better thought of as the variability of returns around your expectation. And so this one particular number of the probability of a crash, and we had to define it in a particular way, that's not so useful in deciding your asset allocation. It's more useful to just have a general idea of the variability of returns together with expected return and your risk preferences to come up with a sensible asset allocation. There's always going to be a pretty significant probability of a crash. That's why we get compensated for owning equities, or why we should get compensated for owning equities. And so it's not surprising that the probability is significant. I think that you might be surprised, though, exactly with the number that we come up with. And we'll also have a survey in there, our own survey of readers of our article that will be fun. You can submit your answers there too. So anyway, hope you enjoyed the piece. It's a fun one.
Piece is up on our site. Check it out.